Welcome to Relax, We Got It. A private limited company and a public limited company are two types of legal structures for businesses that are distinct from each other in terms of their ownership, management, and legal requirements. A private limited company is a type of business structure where the ownership of the company is restricted to a few individuals or groups. The owners are referred to as shareholders, and they invest their money into the company in return for shares. On the other hand, a public limited company is a type of business structure where the ownership of the company is not restricted to a few individuals or groups. The company can raise capital by selling its shares to the public, and anyone can buy and sell these shares on the stock exchange. Here are some of the key differences between a private limited company and a public limited company. 1. Ownership. In a private limited company, the ownership is restricted to a few members who are usually family members or close friends. On the other hand, a public limited company can have numerous shareholders, and anyone can buy and sell shares in the company. 2. Capital. The minimum capital requirement for a private limited company is less than that of a public limited company. In a public limited company, the minimum capital requirement is usually higher than that of a private limited company. 3. Transferability of shares. In a private limited company, the transfer of shares is restricted to the existing members only. In contrast, in a public limited company, shares can be freely bought and sold in the stock market. 4. Legal compliance. A public limited company is subject to more legal regulations and requirements than a private limited company. A public limited company is required to comply with the regulations of the Securities and Exchange Board of India, SEBI, while a private limited company is not. 5. Disclosure of information. A public limited company is required to disclose its financial and other information to the public, whereas a private limited company is not required to disclose its financial and other information to the public. 6. Management. In a private limited company, the management is usually handled by the owners themselves. In a public limited company, the management is handled by a board of directors elected by the shareholders. 7. Funding. A public limited company can raise funds more easily than a private limited company, as it can issue shares to the public and raise funds from the stock market. In summary, a private limited company is a company that is owned by a few individuals and has restrictions on the transfer of shares, while a public limited company is a company that can have numerous shareholders, and shares can be freely bought and sold in the stock market. Public limited companies are subject to more legal regulations and requirements, while private limited companies have fewer legal requirements. Thank you for watching our video. Hope you liked it. Like, share and subscribe.